InPlay Oil pays dividends every month, has doubled its production in 1 year, and is still trading at an EV/EBITDA of 5. WTI is currently just under $100, while the company budgeted with 63. What this means for the free cash flow will be explained in a moment. As always, I also have the stock in my own portfolio. And today I'll show you why I hold it and where the risks are as well. My entry price was €7.22, and right now we're at €11.55. Currently, that's a price gain of 60%, and I've already received a net dividend of €24.45. The 52-week high and low are between €6.54 and €18.96. That's in Canadian dollars. InPlay is a Canadian light oil producer from Calgary, drilling horizontally in the Cardium Play in west central Alberta, specifically in the Pembina and Williston Green Pools. Why is that important? Cardium is one of the oldest and best understood oil fields in Canada. New technology, horizontal multi-frac wells, now extracts oil that was never accessible with vertical drilling. And the numbers here clearly speak for themselves. In 2025, InPlay produced an average of 17,000 barrels of oil equivalent per day, 61% of which were light oil and NGLs. This is important because light oil commands higher prices than heavy oil. In April 2025, the transformative equalization Pembina assets were added in the core area. As a result, production here was almost doubled compared to 2024 when it was still around 8,700 barrels of oil equivalent per day. Now let's move on to the fiscal year figures for 2025. Revenue, 291 million Canadian dollars. Operating income, 144 million. And that's a margin of 49%. That's strong for the oil industry. Adjusted fund flow, 114 million, up 67% compared to the previous year. Free adjusted funds flow, meaning what's left after capex, is 62 million Canadian dollars, and capex was only 52 million, which is 17% below the previous year. So less was invested, more was produced, which means efficiency is right here. Now to the downside. On paper, there's a loss of 7.8 million. Sounds bad, but it isn't. 10.8 million of that are acquisition costs, so it's a one-time effect. Operationally, the business and the company are running well. The reserves here are incredible. We have total proved plus probable at 120,000 oil equivalent. That's a reserve replacement of over 1,000%. The reserve life is 17 years on a TPP basis. That means at current production levels, the reserves are sufficient. 17 years. Now let's move on to the dividend, which is paid monthly and is currently quite substantial. InPlay pays a monthly dividend of 9 cents Canadian dollars per share. That adds up to a total of $1.08 per year. At a current price of just under 18 Canadian dollars, that's about a 6 to 8% yield. Depending, of course, on where you ultimately bought in. For my part, I bought at around €7.22, as you saw earlier. That means you were looking at a yield here of about 10%. The dividend budget for 2026 is set at 30 million Canadian dollars. According to guidance, the free adjusted fund flow is expected to be between 48 and 63 million, and that's based on just $63. But WTI is currently at almost $100, and that's not a typo. The US-Iran conflict has pushed the Hormuz risk premium up to $14 to $18. This means that the actual dividend coverage is currently far above the guidance. Exactly how much is hard to say, but the direction is clear. Since November 2022, InPlay has cumulatively paid out 70 million Canadian dollars to shareholders, distributed with a market capitalization of 500 million. That's very respectable. But note, the dividend is not covered by net profit. The payout ratio appears negative due to the book loss. That looks bad on screening sites. But operationally, is it still okay? With oil below 55, things just get tight here. Possibly. EBITDA at around 5 for comparison, this time with Pierce Cardinal Energy at 4, further at 4.5 InPlay, is minimally more expensive, but is also growing significantly faster. Net asset value on a total proved basis is 30 Canadian dollars per share. The share price is at 18. That's a 70% upside. If the market fully prices in the reserves on a TP basis, it's even 44 Canadian dollars, and that's nearly 150%. Analysts even see an average price target of $18.50 with a high of 21 Canadian dollars. So not much off the mark in a 12-month view. WTI is currently trading at just under $100. This is not normal. It's a geopolitical risk, a premium due to Iran and Hormuz. In this scenario check, I assume the normalized oil price and not the current spike. That means here you have the bull case. For BTI, that would mean prices above $75, and we would have a price target of about 22 to 25 Canadian dollars. And here, it could be the case that special dividends and buybacks are carried out. In the base case at $63, here the price target would be around 18 to 20 Canadian dollars. And the dividend would be stable here, and we would see good debt reduction, and the company would essentially meet its targets. And in the bear case, that is, below 55 WTI, we would have a price target of 10 to 13 Canadian dollars. And here, even a dividend, a cut would be likely. The current WTI spike is a blessing for InPlay, massively increasing free cash flow, but geopolitical oil prices cannot be sustainably planned for. The company is therefore calculating quite conservatively here. Let's briefly talk about the risks and what could simply go wrong here. Oil price, the biggest risk for any E&P. At WTI 55, the dividend is no longer covered. Currently, WTI is near 100. Sounds good, but the geopolitics, the premium evaporates as soon as Iran and the USA reach an agreement or Hormuz is open again. Then WTI can fall back to $65 to $70 within weeks. And here as well, don't fall in love with the geopolitical spike. Then we have the debt issue. 218 million net debt plus 242 million senior bonds with a market cap of 500. Out of 500 million, that's no small matter. Net debt to EBITDA is at 1.3 to 1.4. Still in the green, but there's no cushion. Now let's talk about the US tariffs on Canadian oil. The Trump administration has threatened this multiple times. If tariffs are imposed, the WCS discount increases and InPlay realizes less per barrel. Now let's move on to the concentration risk. 100% cardium in Alberta. No geographic diversification here. On the positive side, Dell Group, an Israeli energy company, has acquired 32.7%. That's a strong signal. Strategic investors don't invest in companies they consider to be overvalued. So let's move on to my conclusion. InPlay Oil is an operational powerhouse. Production has doubled, costs have been reduced, reserves have increased sixfold, and the monthly dividend with a 6 to 8% yield is covered by the cash flow. At the current level, close to a 52-week high at around 18 Canadian dollars, it's not a buy for me right now. But I'm very happy to hold this position, and if there are setbacks, I'm also willing to buy more. So what would be a target I would set for myself here? Between 10 and 12 Canadian dollars, I could imagine buying more here, but I would analyze it beforehand. And of course, I'll let you know if I decide to get back in. So for now, I would wait for pullbacks, and they usually always happen anyway. The only question is usually just when. If this upstream series is helpful to you, make sure to hit the button every time. Usually a new analysis comes out on Monday, Wednesday, and Friday. The time slot isn't fixed though, but I definitely try to put out 3 videos per week, and usually there's another one on Sunday as well. A weekly review for you where I go into a bit more detail, and I even have a newsletter you can sign up for. You can find it on my website, and there you'll also get the weekly review sent to you by email if you like. That's it for this video. As I said, if you enjoyed it, feel free to leave me a like. If you're not a subscriber yet, I'd be happy if you became one now. Otherwise, as always, I wish you successful investing. This video does not constitute investment advice. See you in the next video. Until then.